Deere is one dividend stock down 17% that you might regret not buying on this dip here. In this video, I'll explain why I think that's the case. So let's begin. Starting with Deere's dividend yield of 1.27%. Now, this might not be as good as the 10-year government bond yield, which is near 3.25% as of this recording. However, that government yield is constant, whereas if you invest in Deere stock over the next decade, you can reasonably expect Deere to increase that dividend payment over time. So why will it increase that dividend payment over time? Well, dividends are paid out of earnings per share or profits. And I suspect that Deere's profits are looking good for the long term. And now let's look at the next case why I think that's the case. So look at Deere's revenue here over the last decade. Look at the jump here since 2020, absolute explosion here to 51.85 billion. Way better than where it was before the outbreak. One of the reasons for this is because inflation has helped Deere, because Deere's clients who purchase Deere's equipment benefit from higher commodities prices. So higher commodity prices increases demand for Deere's equipment. So that's been one side of the boom for Deere's equipment. The other side of the boom has been the innovation, the technological innovation Deere has implemented in its equipment. That's created a boost in demand for Deere's equipment. Deere's been able to implement double-digit price increases that customers have paid. In fact, customers have been in such high need for Deere's equipment that there's a backlog that will take much of 2023 for Deere to fulfill. They've got all this backlog of orders going out. You know, they've said it'll likely go into the second half, perhaps even all the way to the end of 2023. So Deere's prospects are looking great. Now, in addition to its revenue, look at what that has helped create for its operating profit margin. As revenue has increased, so has its operating profit margin, from a low of around 10% in 2016-17 up to 21% in its most recent trailing 12-month period. So a greater revenue total coupled with a greater operating profit margin means much higher profits overall, which means investors can reasonably expect that some of those profits will be funneled to greater dividends per share over time, right? Not immediately, but over time. As the company feels comfortable with these greater profits, they'll say, okay, we've got more profits now. Our business is in good shape. We can go ahead and return some more capital to shareholders if this persists for the next several years, which I suspect maybe not to this great a degree, but I suspect Deere's really good prospects will persist for at least the next few years, because I don't believe the prices of commodities are going to come down anytime soon. So for that reason, Deere's equipment can continue to be highly in demand. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. And the final reason why I think you might regret not buying Deere stock on this pullback is because of its reasonable valuation. Deere is trading at a forward price to earnings ratio of 11.74, which is a reasonably cheap valuation compared to all stocks in the market. It's also relatively inexpensive compared to its own historical average here, going back about a year and a half or so. It's about at the average price the stock has been during this time. So it's not like you're paying too high a price for Deere stock. All right, so for that reason, I think you might regret not buying Deere stock on this dip. All right, that's all I've got for this video. Thank you so much for watching. I hope to see you again soon.